And so first of all, thank you all. Thank you for being here with us today. My name is Krista Yankee, and I'm a Senior Communications Officer at the Kresge Foundation. And today we're having this informational webinar with our social investing team on how Kresge uses multiple tools to expand opportunity in America's cities. A little bit of housekeeping before we get going too much further. I just want to let you know that, first of all, this session is being recorded. We would love for you to continue to use the chat function to introduce yourselves and to have any kind of discussion as we go along. If you do have questions for our team, we do plan to take questions and answer as many as we can. There's a Q&A function that's just over from the chat function. It says Q&A. That is the funnel where we ask you to put questions so that we can see them all in one place. And we'll be getting to those at the end of the presentation. We will be sharing out the recording of the webinar on our YouTube channel, as well as Kresge's website, which is kresge.org. And I will plan to send out an email to all of the registrants of the webinar with the links to those slides and to the presentation. So rest assured, you will get that. All right, this is the agenda. This is what we're gonna walk through this afternoon. So we're gonna just do a little bit of introduction of the Kresge Foundation and then introduce our full social investment practice team. We're gonna talk through how we at Kresge approach social investing, and we're going to explain the different social investing tools and give a few investment examples of how we've put those tools to use. And then, like I said, we're going to definitely save time for questions. So please, be thinking of those, and you can drop them into the funnel at any time. So before I kick it to the full social investment team, I'm just going to do the brief overview of the Kresge Foundation in case we are unfamiliar to you. So the Kresge Foundation is a private foundation that is headquartered in Troy, Michigan, which is just outside of Detroit. And we also do have a satellite office in Midtown Detroit. We were established in 1924. And so we're approaching our centennial in just a few years, which is very exciting. We were founded by Sebastian Kresge. He was the founder of the Kresge Company, which was a five and dime operation that grew to be one of the largest in that time. Eventually in the 60s was sold to become the Kmart Corporation. So if you've ever wondered what the K in Kmart is, it is Kresge from our founder. Kresge invests about $160 million a year through grants and social investments, making us one of the largest philanthropy organizations in the United States. And this is our mission that you can see here. It's to expand opportunity in America's cities using grants and social investments. We work nationally as well as, with place-based community development approaches in particular cities, which includes Detroit, New Orleans, and Memphis. And we also, nationally, we focus on issues such as creative placemaking, environmental justice, the social determinants of health, expanding access and success in higher education, advancing the human services sector to address the root causes of poverty, just to name a few. And we layer a explicit focus on racial equity over all of that work. And we're led by 6 institutional values, which are creativity, partnership, stewardship, equity, opportunity, and respect. So that's the foundation. The social investment practice team is who you're here today to learn about. The social investment practice works across Kresge's 7 program teams to strengthen neighborhoods and improve the quality of life in America's cities by addressing barriers to capital. So we're going to get much more into exactly what that means and looks like as we go along. And I'm going to turn it over at this point to the team's managing director, Aaron Seibert, so he can introduce himself and bring in the rest of our team. Aaron?
Sorry, Aaron, I can't hear you. Are you maybe double muted?
We'll try again.
There we go.
there we go. Cursed double mute. You would think after almost 2 years I would have that down, but no. So again, welcome. Let me jump right into it. So I'm Aaron Cyber. I'm the managing director of the practice, as Krista said. I joined the foundation, I think we're on 6 years now, which seems like yesterday. But I came from JP Morgan Chase, got a long background in community development finance, doing both buy side and sell side on various tax credits, but also specialized lending, a lot of affordable housing work. Have always been in the community development finance space. It is the only thing I know or love or care about outside of my friends and family, and I'm thrilled to be doing this work. I am joined today by a bunch of other very impressive community development finance professionals, who I'd like to introduce right now. So let me start by turning it over to Erica Bryce, who just joined us, Erica, 6 months ago?
Five.
5 months ago.
Yes, so thank you, Aaron. So hello, everybody. Again, my name is Erica Bryce, and I actually joined Kresge in April of 2021, so I think I hit 5 months on the 12th. And I came to Kresge with about 20 years of experience, really focusing on commercial real estate finance and investment in projects across the country. So a lot of affordable housing, community development deals, economic development deals. So really the theme of my career has been deals that have impact, deals that require more than just a financial return, but we're really looking to have a change occur as a result of the investments made. And through that experience, I also gained some expertise in blended capital financial structures, particularly with institutional investment and public-private finance, public-private partnerships and finance. And really, of course, tax credits, because how do you do community development without tax credits? So I'm gonna pass it off to my colleague, the other investment officer on our team, Tasha Tabron.
Hi, everyone. Tasha Tabron. I am a native Detroiter, and I would say a serial community practitioner, development practitioner like Aaron and Erica. Came to Kresge this year with, again, 20 years of experience in the community development lending space, as well as grant making, primarily in the private sector with financial institutions. And my focus within Kresge social investment practice will be in the placemaking space, supporting our grant makers with all the tools you'll hear about today. And I'll turn the floor over to Joe Evans, who will also give you some perspective on our portfolio management team.
Hi, everyone. Joe Evans. I'm the portfolio director. Together with my colleagues, Chris Cox and Will Guzman, we are responsible for the asset management of the existing portfolio. About 80 investments, approximately $300 million in total commitments, split pretty evenly between loans and equity on one side, about 40 plus investments and $150 million, and an approximate same amount of investments on the unfunded guarantee side. In addition to, Chris Cox comes to us most recently from Sinair, where he was a long-term CFO and helped grow that institution over the years, an entity in which we also have an investment. And Will Guzman comes to us from where his second job after college. Prior to joining our team, he worked for a bond investor in New York City and monitored the health of cities, which was a nice parallel to monitoring the community development finance groups we invest in. In addition to serving as a portfolio director, I'm also a social investment officer supporting our environment team, where I help them advance their strategy with these capital tools to reduce greenhouse gases, to ensure new technologies get to the communities that we care about, and to help cities prepare for the effects of climate change. And then I forget who I'm turning it over to next. I think back to Aaron.
Actually, she's going to go directly to
Nisha. Sorry.
Hi, everyone. Nisha Modi. I have been with the foundation for 6 years. Actually, Aaron and I started around the same time. I've spent the first 5 years of my time here at the foundation on the grant making side. So as a program officer on our Detroit team, focused on grant making within the city of Detroit. For the past year, I've stepped into a role that is squarely focused on stewarding the alignment of our operations with our mission and how we do our work in community. And prior to that, I was in private consulting, a couple of big firms, but really excited to have brought all of that experience kind of full circle to where I am now, with a mission-driven focus. I'm going to turn over to Julie.
Hi, everybody. Thank you, Nisha. So my name is Julie Burlingame. I'm the assistant for social investment practice. I came to the foundation about 4 years ago. Previously worked for Edward Jones in administration. I managed several different financial investment offices around the Metro Detroit area. I also got my bachelor's degree from Oakland University, where I focused on grant and professional writing. Also wrote a thesis on social justice. And since being in this role, I have started to assist the team both on day-to-day operations, as well as providing support on any ongoing projects, helping with grant work, and also assisting with systems building among the team as well as the foundation.
Okay, thanks, team. So that is the core team, but we also are lucky enough to work closely with our partners in grants management, as well as across our program teams with different program officers, which we'll get into in a few minutes. But I want to give us just a little bit of context to understand where the social investment practice sort of sits, both inside of the foundation, but in the larger impact investing world writ large. You know, impact investing is a rapidly growing field, but it comes with a lot of different definitions to it. And so if people try to contextualize this in all different kinds of ways, this is the way that we think about it, or perhaps the way that I think about it. In the far right side of this little graph, you have sort of environmental, sustainable governance issues where many endowments, foundations, private investors screen out things like oil and gas and firearms, for-profit prisons, that sort of thing, and sort of deem that to be impact investing. If you move along the continuum towards the left, there are those sorts of screens plus additional impacts they're looking for yield, but also looking for targeted impacts in a sort of double bottom line fashion. If you move all the way over to the left, it's really where our practice sits. As a private foundation, we are very, very squarely focused on impact, and impact is defined by our program teams and their strategies. When I say program teams, I'm really talking about the individual teams who have grant budgets, whose primary work is grant making in their respective fields. They all have very fleshed out strategies, very expert staff, and outcomes that they are driving at. And we're here to complement those things. So while we are an investing operation, we do not work for the endowment. Our job is not to invest the foundation's endowment. We are not here to grow the returns. We are a separate unit inside of the foundation where I report directly up to our president as a peer to our CIO and our head of programs. And then we work in partnership with those teams to deploy resources. But to be very clear, our dollars are charitable dollars. And so our mandate is truly to generate impact and accelerate the impact of the program teams, to leverage additional capital and to unlock capital for our investees and grantees, to preserve our capital, to have our capital returned to us. And then if we're able to make a financial return on that money, then that's great. But we are sort of focused in that order. And that's an important thing to understand about where we sit inside of the sort of impact investing ecosystem. The sort of, if we're a box 1 degree to the left, it would be a grant where there's no return of capital expected, and we are solely focused on the income or about the outcomes or the impacts of the investment. So I wanted to give that context. The other thing to note is typically in our space, the availability of capital becomes greater the further to the right you move. You know, over time, we're sort of hoping that changes, but there's a lot of scarcity of capital in our space. And, you know, in our practice, we might do $15 to $20 million of cash commitments in any given year and another $15 to $30 million of guarantee commitments. And there's a lot of opportunity cost that comes along with those choices. So again, we'll get into how we make decisions, but that's the context of our practice. Chris, I think I'll move on to the next slide. This slide's just a very brief history of social investing at Kresge. You know, we're a nearly 100-year-old institution, but for the vast majority of our history, we did almost nothing but capital challenge grants. So if you were to go to any major university around the country or library system or large nonprofit center, there are Kresge libraries and dorms and eye centers and all sorts of buildings that carry the Kresge name. And that was the strategy for the bulk of the foundation's history. When our current president, Rip Rapson, joined us, I think we're 15 years now. I'm going to have somebody correct me if I'm wrong about that. 15, 16 years ago, he moved us into more of a strategic philanthropy trajectory where we're trying to effectuate change in the world through different program areas. And then social investing came along shortly after in 2008 as a response to the 08-09 financial crisis. We had a lot of major nonprofits, mostly human service organizations that were struggling to get paid, right? We had crisis in the credit markets, even solid municipal contracts from cities and states to deliver goods and services that were on a reimbursable basis were suddenly at threat, right? States and cities were unable to pay because of liquidity crunches. And so we stepped in and provided these emergency bridge loans, backing established revenue streams for nonprofits to bridge them through that crisis. And, you know, at the time I wasn't here, but, you know, I have a job today, so I assume they thought it went pretty well. And it was a worthwhile effort for a foundation to broaden its reach in both its aspirations, but also its tool set. And so in 2010, we hired Kimberly, who many of you know, to set up the practice and to launch us into a new era of strategic grant making and investing using multiple forms of capital. In 2015, we got $350 million committed from our board to invest in this work. That's both cash and guarantee. And we've had a number of milestones. In 2020, we passed $1 billion in leverage on our capital. We launched some major initiatives around the community investment guarantee pool. We made strong pushes into the sort of federal partnership space and PPP bridge lending and finished out that original commitment. We've gone through a new strategy process last year, have restaffed the team to the sort of lovely set of folks that you see in front of you, and are moving into the next slide now. Chris, I think I'll go to the next slide. So when we talk about investing, you know, I'm always pushing the team to think about the position that our grantees and investees are in, right? We are not a product delivery shop, right? This is not banking where you design a product. I say all the time, find a product that you can make a nickel at and do it 1 billion times, right? That's the sort of business model in traditional financial services. And we're not that. We are here to deliver a complement of solutions to our grantees who are trying to tackle really intractable problems. And so our job is to find the solution and fit the capital tool to that solution and not lead with the tool. But we do say that we do a full suite, right? So we'll do lots of debt. We have some equity investments, both fund level and direct. We use guarantees very sort of broadly and aggressively. And we have a strategic deposit program that we've used from time to time. It's a full suite, right? So any sort of financial services tool that you might find from another provider, we'll deploy here to fit the solution. And oftentimes, and you know, most desirably, we do it in companionship with a grant-making strategy, so that we are using all of Kresge's services to support our grantees and investees. But we do have a few examples that we're going to walk through, and we're going to preserve some time for questions at the end. So I'm going to first turn it over to Erica, who's going to lead with, I think, our first debt example.
Hi, everybody. So today I'm going to talk about how we use PRI loans, which is one of our most common tools. And so the example I'm going to use is actually the Healthy Futures Fund. And so the Healthy Futures Fund was a first of its kind $100 million fund that paired low-income housing tax credit capital with new markets tax credit capital. And so for context, the fund was in response to the passage of Obamacare and Medicaid expansion back in 2012. And the idea behind it was that you have federally qualified healthcare centers, or FQHCs, that were going to have all this increased demand of newly insured people, a lot of them low income. And so they had this increased demand, and they needed to be able to meet this challenge, right? And we also had a repayment source. And so in this fund, it was done by LISC and CHC Capital, but we also had some newer partners to the table, which was Morgan Stanley, and this was their first time working with FQHCs, as I understand it, as well as Dignity Health, which was one of the nation's largest healthcare systems. And so in this project, Kresge made a $6 million PRI loan for a period of 8 years, which was congruent with the new markets tax credit structure. And so why we did a PRI loan, number one, because the Kresge funds filled a critical gap to help FQHCs respond to the demand. And we knew that there was a repayment resource via this new policy or this new legislative tool, right? Also, we used a loan because it structured and preserved our capital. And so that capital can be recycled, so while still serving its purpose in the transaction. So that's why, you know, a grant wasn't the best or some other form, but this really made the most sense. And then finally, as I talked about the partners that we had in the project, our capital induced new investors to the sector. And again, when Aaron's talking about the limited capital, I was trying to think about how can we get other capital in there. And so this deal achieved systems change. Number one, it aligned with our health team strategy for social determinants of health, which is at the first and foremost at the forefront of anything that we do. The model reduced transaction cost because it was a different type of model. It leveraged the policy environment to expand Medicaid and address the social determinants of health. And it induced new investors to the market. Excuse me. Most importantly, it reduced the reliance on Kresge capital, and the model was replicable. And eventually, because of the first fund, they actually were able to induce additional banks to come in. And so we did the second fund. But in the second fund, we were able to do a $2.5 million guarantee because our capital was not needed in the same way. And so Tasha, my colleague, is going to actually talk about guarantees, I believe, next, and she can give more detail there.
Hi, everyone. So as Aaron and our team has pointed out, you know, we're working with our grant partners, and oftentimes what we identify when talking to our partners is the goal is really a market correction. There is a need for private capital to move into places and reach people very differently. And the North Star would be that we get private capital participation into this market correction or this investment that we hope will correct the market. There are a lot of financial institutions on the phone, and I hope this resonates with you, but we basically want to use your capital, and what Kresge will do is protect it. In other words, let us be the mitigant for your default risk concerns by offering a guarantee. And as an insurance coming from a multi-billion-dollar entity, as we talked about, that's usually very valuable and helps banks get over the hump, or our financial institutions get over the hump of putting up their private capital, which you have more of than us. So in this example that I'm going to talk about, the Detroit Home Mortgage Program, the market correction here is we had to address the appraisal gaps in the marketplace. So we had home buyers that were looking to enter into the city of Detroit and buy and purchase homes. But with the bounce back of what was happening in the city at the time, the markets was below market, and we were seeing an appraisal gap. So in 2014, for example, we noticed of only 12% of the home sales in the city was actually attached to a mortgage. People were doing cash sales, or what investors were being able to take advantage of the market, but home buyers were not able to get the resources that they needed to not only acquire the homes, but also fix them up. So an investment was put in place in 2016 with the cooperation of a number of banks and nonprofit partners, and the help of Kresge and other foundations to create an innovative product that, one, will allow the banks first to use their own forced mortgage products to help these home buyers, but then have a second mortgage attached that would allow them to do renovations on those products, and that would be protected by a guarantee from the Kresge Foundation. And that unlocked about $30 million, what we expected to be about $30 million in leverage and home mortgage products from those banking institutions. And again, the thought process here is that we weren't trying to correct something in the market that allow for us to bolster the markets in these emerging neighborhoods, and move more single family product to home buyers that were aspiring to move into those markets. And that was the use of the guarantee in this particular example. I think I'm turning.
Thanks, Tasha.
We're going to advance a slide. So Joe Evans again. I'm going to talk a little bit about equity investments. And as Aaron said when he was in some of his opening remarks, we tend not to lead with the tool. We put the sort of problem in the center and put the solution first, and you know, structure our investments to help best support the solution. Primarily, or in large part, our partners have been our nonprofit financial intermediaries, in whom we cannot make direct equity investments. And mainly because of that, equity investments are probably our least used tool. But there are situations where it's the right tool to use. And the example I'm going to talk a little bit about is called the Southern Equity Fund. It was a $45 million fund to make deeply subordinated loans to community development credit unions, loans that their regulators would count as equity. But the partner who, the Inclusive, which is sort of a trade organization and a lender to the community development credit unions, its balance sheet was about the same size as the fund we were trying to build. So they did not have the ability to take on all that debt onto their own balance sheet without really upsetting their existing leverage ratios. And although they were really well capitalized themselves, they didn't have the equity to sort of support the fund. These deeply subordinated loans are known as secondary capital. It's an asset class that isn't well known in the sort of across the capital markets, but we were hoping to change that. And but because and we were bringing in like new capital providers into the space, because the tool or the asset class wasn't that well understood, they really wanted a sizable amount of equity underneath the capital stack. And so the combination of the not being able to put it onto our partner's balance sheet directly, and then also the desire for that cushion amongst the capital markets, led us to have Inclusive create a new for-profit entity that sits off its balance sheet. We invested equity along with Inclusive into that to support capital investors who came in with debt. A $45 million fund will support a dozen or more of these loans to credit unions, who then will be able to provide up to like 30,000 people previously unbanked with equitable financial services. We have other examples where we've used equity as the right tool, either convertible notes into for-profits when we're trying to encourage them to bring their new technologies into the communities that we care about, developers in some of our focus cities where again, they don't have the equity on their own balance sheet to sort of realize the scale of the vision that we're supporting them to create. So I think just the takeaway here is that it's a tool in our toolbox, and we've used it with some success, but we only employ it when it's like the right tool for the job.
That's great. Thanks, Joe. So I'm going to touch quickly on how we work. Oh, Chris, I think we got to go one more. Did we already do this one? I might have skipped ahead.
I think you might have skipped a slide. We're seeing the Strong Families Fund slide. Is that what?
Yeah, this is
Julie,
this is Julie.
Okay.
Thanks.
Julie Burlingame again here. I'm going to talk quickly here about our grant work that we do. So while our team is very focused on how we can use these investment tools to achieve mission, we still do sometimes make traditional grants. We have a small grant budget that we use primarily to support field building activities in the impact investing sector. We support organizations like Mission Investors Exchange and Opportunity Finance Network to help strengthen the infrastructure of this field. Where we make bigger impact with grant dollars is when we partner with our program teams, which have much larger grant budgets than we do. Together, we assess and identify any potential investment opportunities that we could use, that could use capacity building or technical assistance via grant dollars to prepare them for the investment. This work is common where program grants lay the groundwork for follow-on social investment. We also often pair social investment with grant dollars from our program teams to support operations and other types of capacity building for the organization. There are many examples of this in our portfolio. The one pictured here comes from the Strong Families Fund, in which we have made a program-related investment loan, followed that with 2 guarantees, and also provided $1.25 million in grant support. The Strong Families Fund goal was to finance construction and renovation of 600 to 700 affordable housing units in a 3-year period, when we also provided support for on-site access to high-quality social service coordination for at least a decade.
That's great. Thanks, Julie. I'm sorry about that. Okay, so we get questions all the time about how do we work with partners, how do we source investments? And so the best way to understand it is to go back to where we started, just really around our program areas, right? The social investments practice does not have a separate strategy. We work inside of these program focuses. Each one of these grant-making teams has a very well thought out, very focused strategy around the kind of change that they want to make in the world. All the teams are urban focused, so we work almost exclusively in cities. All the teams are low income focused, and all the teams have a strong racial equity commitment in each one of their program strategies. So we are working in partnership with those program teams to look at the sort of scope of the grant making that they are doing and to find different opportunities to bring new forms of capital into their space in a way that accelerates the impact that they're doing. So the first question we always ask is it a fit for a program? What program strategy does the opportunity in front of us fit into? We then start thinking about what is the capital barrier here, right? I mean, I say all the time, we get hundreds of millions of dollars in affordable housing subsidy requests every year, right? We can't possibly support that need. And there's a structural barrier there. We would, generally speaking, not step in to just be the cheap money or the most at-risk money. What we're trying to do is figure out, why is the market broken? Why is the market discriminatory? Why is the risk-return calculation wrong here? And what do we know that the market doesn't know that convinces us that if we step in and make an investment, we can correct that market failure and unlock a clearly identified source of capital to follow on behind us. And then we structure an investment that tries to unlock that capital. So that's the second look that we do, is to look at what is that capital barrier that's preventing dollars from flowing into the people and the places that we care about. Third, that pipeline strategy, as I said, really does fit inside of the program team, what they're building, right? So grant makers, generally speaking, are in the influence business, right? They're trying to influence the sectors in which they operate to operate differently. And so a really good example would be in our health team, where they've had a high degree of focus on social determinants of health. Over the last few years, we've worked a lot with different hospital systems to help them find ways to invest in social determinants of health that bring better community health to the places that we care about and communities across the country. And so we look at that grantee list, we look at the hospital systems that they're working with, we look at the nonprofits who are trying to push into the health space using social determinants of health to improve the quality of life for people, and then try to find the opportunities to invest capital to accelerate that work. And then finally, similar to a lot of credit shops or other investors, the underwriters that you met previously take a deal soup to nuts. So they find the transaction maker scope, they size the investment appropriately, they do the diagnosis on the capital barrier, they do a credit write-up, for lack of a better term. We have a credit that's constituted of board members and internal folks from both program and operations, finance and accounting, and then the leadership team. We vet these transactions. I like to say that, and I'm sort of carrying this on from my Kimberly's sort of moniker, that we don't ever want to be the stupid money in a deal, but we're very happy to be the risk tolerant money, because we think that we, given the source of our capital, it's an obligation for us. And then we do a lot of evaluation around what the opportunity cost is of the investments we made. As I said before, we do 15 to 20 in cash commitments a year, maybe another 15 to 30 in guarantees. We get many, 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 many more requests. And so every investment that we make, there are many, many, many investments that we're not going to make. And so we have to weigh those very carefully. That's why we rarely do open calls because inside of our existing grantee portfolio, there's lots of folks who need the kind of capital that we can deliver to a problem. And so we primarily work inside of that grantee set. But when we do step outside of it, it is in high coordination with our grant making partners so that it fits inside of their strategy. I'll also note that we rarely do direct project finance, particularly outside of our focus cities, which for Kresge is Detroit, Memphis, New Orleans, and recently Fresno. You see the full complement of people here. When I was in banking, we had, 10 times as many people working on project finance in our unit. It's highly capital intensive. It is extraordinarily time intensive. So we rarely will step into an individual project. Similarly, we don't do a lot of social enterprise work, which is something that other foundations are more focused on. Direct investing in general is challenging for us just because of capacity and capital constraints. We do it, but it has to be the right fit. There has to be the right scale for us. And most often it is in the focus cities where Kresge is doing a lot of high intensity grant making. So with that, Krista, I think I'm turning it back to you.
Yes, thank you, Aaron. So that is our whole presentation. We are going to be doing questions at this point, and there are already a few in the funnel. Thank you so much. If anyone else has questions to drop into the Q&A funnel, you can go ahead and do that. Before we get to those, I just wanted to point out some of the ways that you can stay connected to us, which you can see on the screen here. But we are on Twitter at Kresge SocInv. We are also sending out a bi-monthly newsletter called Mission Money Market. If you visit our website, kresge.org, we have a social investments landing page. We have a database of the investments that we've made over the last decade plus. We also, in our resources section of our website, have more than 24 case studies of individual investments that walk through what were we trying to do with the investment, why did we use that tool, and so on. You can subscribe to our newsletter at kresge.org/subscribe, and you can also reach out to us over email at sipinfo@kresge.org. At the end of the session, I just want to note I have a short 5-question survey that I'll share a link to, so you can just give us some immediate feedback about the usefulness of our webinar today. We'd love to know your feedback on that. So I will share that after our questions and answers. So I'm going to jump into the questions now. And the first one is about getting unsolicited pitches. And basically, what is the best way for people to let us know about projects that are seeking capital?
I'll take this one. So as I said, we generally speaking don't take unsolicited pitches, particularly for project finance, for the reasons that I stated previously. I always encourage people to start with our website and our annual report and really try to understand what the program teams, the grant making teams, are trying to accomplish in the world. Right? These are not like general strategies. They're actually highly specific and very narrow into what sort of change in the world they're trying to effectuate. And the best way in the door through us is through a grant making program, right? We're always going to start with a place where our grant making partners feel that there's a collaboration to be had. That's not to say that we don't look at sort of outside solicitations, but I always want to see them, and I think the rest of the team would echo this. We want to see what the connection to the program strategy is. And we certainly occasionally walk opportunities in the door with the program teams, but there has to be a very, very clear alignment with what, not generally speaking, but a very clear and specific alignment with what the program teams are doing between our very excellent website that was recently redesigned by a fabulous communications officer and our annual report. You can get a really good sense of what Kresge is trying to do in the world.
Great, thank you. And before I go to the next question, I did see in the chat a few times people asking about getting the presentation and the slides, and just a reminder on that, we are recording and we will send out over email a link so that you can get the slides and the recording. So, all right, the next question is about, in terms of structure, do we have a preference for PRIs, recoverable grants, direct investments, loan guarantees, or other approaches?
So I'm going to try to rattle through these just to be efficient because we've got a number of them in the queue. No, we don't have a preference on the tool. And as I said, we try to fit the tool to the solution that we're trying to deliver. I mean, almost everybody wants a grant, right? If you can get a grant, you should definitely do that. But you know, what we're trying to do here is understand, why is capital not reaching the people in the places that we're focused on? And then what do we do to unlock it? And we're going to try to design that solution against that capital barrier to maximize the impact of the investment that we're making, as opposed to, you know, doing a portfolio allocation theory, which we don't do. I mean, we have our own risk metrics that we measure, and we have pretty robust portfolio management practices, but it's not the tail wagging the dog. We're going to fit the tool to the solution.
Great, thanks, Aaron. The next question is on, is there any minimum or maximum dollar amounts for our loans that we make? So, want to take that one, Aaron?
Joe, why don't you take this one and just talk about sort of what we have in the portfolio on, you know, average?
Sure. Yeah, I would say the answer to the question is no, we don't have a minimum and maximum. We really do try to fit not only the tool, but the dollar amount to the need and to the solution that we're working on. With that said, the vast majority of our investments are between, on the sort of cash funded side for loans or equity or deposits, are between about 500,000 and 5 million, which probably 2 to 3 million, the most kind of common dollar amount. On the guarantee side, there's a little more variation, and they tend to be larger, sort of with a floor of about $1 million and going up to as large as 10 million. I would say, however, that largely we found the larger guarantees tend to, we've had some mixed experience with the very large size guarantees and seeing the full utilization of them and the time that was that was assigned. Because if we're really successful, then often the capital markets kind of move in without us, and it's a little clunkier to invest if you have like a foundation as part of your capital stack providing credit enhancement. If we've helped to prove the efficacy of an investment, then our guarantees kind of no longer needed. So on the guarantee side, we're probably around an average of about 5 million, which is maybe close to double the size of the average on the loan side.
Joe, why don't you take the next one too on benchmark for rate and duration?
Sure. I mean, a lot of there's a couple other questions in here that are sort of similar, where we don't have standards, we don't have, we don't have a rate sheets, we don't have standardized terms. We really do fit and structure the investments to the need that we're trying to advance. The market rate too, I think, is sometimes we've used it in our presentation. It's kind of a shorthand in this space, and a market rate really varies by the market that you're looking at or that you're investing in. I would also say that since the pandemic hit and a lot of the recovery money and other money that's coming into the space has changed what people might consider the market rate, and where our capital, where we've made a number of loans over the years at 2%, 10-year terms into the community development finance space. Today, that money isn't quite as needed in quite the same, in our view, as it had been in the past, because there's a lot of other sources out there at lower rates. And the sort of historic lows of interest rates generally that we're having has sort of, we haven't, we're not going negative on our rates, but I think we tend not to focus on the rate. And really our focus is there a capital barrier that our capital can help address? And if so, then often the rate isn't the primary consideration. We're never trying to provide cheaper money. We're almost never trying to make someone have access to less expensive capital. We're trying to ensure that capital can flow into the issue that we're addressing. The longest loan we have, 10 years is probably about our longest loan. We have 1 or 2 exceptions in our focus cities. We probably prefer to be at about 7 years. The next question is about loans. I'm sorry, Aaron, were you going to jump in with something else there? No.
No, I would just say, we're always trying to fit this stuff to what's the capital barrier, right? So we typically don't want to invest on terms that no other more market-oriented investor would participate in, or public sector investor, sort of depending on what it is. So there is no straight answer to this. It's really about the capital barrier we're trying to unlock.
The same with the next question that we have, which is, do we make loans just to nonprofits, or would we make loans to for-profit social ventures? We have loans to for-profits. I mean, as Aaron has said earlier, I think a couple of us have said, so, direct investments into social ventures are difficult for us. Direct project investments are difficult for us because of the time that direct investments take to manage over time. And we're usually trying to address a larger capital barrier as opposed to move one great project forward. So there's no prohibition against us investing into a social venture, but it would have to be a really tight fit with one of the solutions that a grant making team is trying to push forward.
Thanks, Joe.
Chrissy, you want to do the next question?
Yeah. So the next question is about what benchmarks do we use to measure the outcomes of social impact investing, and against what time horizon?
Nisha, you want to take that one?
Sorry, Aaron, I think you should tackle that one. I think it was a mistake in the system.
I'm happy to jump in, or go ahead.
Well, I was actually going to ask, so this is very program specific, right? So the thing that we don't generally do is this sort of, this is a lot like the social enterprise investing model, where it's dollars of impact investments out, widgets of impact back, and then like doing an efficiency ratio around that. That is generally speaking not what we do. Erica, I'm going to ask you to maybe just talk very quickly about, like, inside of the human services team, the kind of outcomes that they are driving at and measuring. And then Tasha, I'll ask you to do the same. Just keeping in mind we don't have a ton of time left.
Mm-hmm. So I'll say really quickly, our human services team, and which has their grant portfolio on the Kresge.org website too, very much focused also right now on policy. And they're exploring issues around how do you create stability for families, how do you prevent poverty, and so their outcomes that they're looking at aren't necessarily like the widgets in, widgets out that Aaron is talking about, but because there's a policy basis too, how does it further along the policy that we're trying to see? So whether it's workforce, whether it is wages, whether it's childcare, right? Are we creating a system that makes it easier for families, number one, to be stable and to thrive and have self-determination? And then are we also doing something that aligns with a policy that is coming to bear, right? So when we talked a little bit about the Healthy Futures Fund as an example, even though there was the health team, there was a policy basis there where we were meeting a need. So there's not necessarily a wedges in, which is out, but it is there a systems change? So Aaron, did I kind of hit that?
Yeah, that's great. Tosh, you want to chime in?
Yeah, I would just say that the place-based practices is looking at opportunities to support, family and children thriving in neighborhoods, and so that's a coordinated set of investments. It's not just one thing that they see that helps create these thriving neighborhoods. So to the extent that that's the overall outcome. One of these investments that we make may be a component of a much larger set of outcomes that they're trying to drive. So, housing is a contributing factor to thriving neighborhoods for families and children, but so is education and the access to that education. So those two together create that thriving neighborhood. So just looking at, additional housing in a neighborhood doesn't necessarily hit the marker for our place-based practice and creating those thriving neighborhood outcomes. We need to have all of these kind of pieces working together. And then we can kind of look at what the outcomes come from all of those investments connected together.
Yeah, if I can also add to what Tasha said, because those time horizons vary, right? When it's supposed to be systems change, sometimes it's longer, sometimes it's shorter. So I would, incorporate that into your thinking about how we look at measuring impact.
So bottom line, it's very program specific. And if you want a better flavor of sort of what program teams are looking at, again, I'd push you to the website of the annual report, which has got a lot of information on the kind of change and outcomes that we're looking for. We've got questions stacking up, so I'm going to try to move through these relatively quickly. Matt asked, did we invest in the Southern Opportunity Resiliency Fund or similar funds in California? So we get a lot of pitches for managed funds that tend to be double bottom line impact and yield, or national funds or regional funds or asset-specific funds, almost always in affordable housing, but other things. We don't do a lot of that kind of investing. It's not that we don't have a high opinion of it. I think that the work that the folks do at SOAR is very important. But because of the scarcity of our capital, our yield, or our impact yield sort of threshold is very, very high. And we don't have a program strategy that is focused on, the sort of the South or the Southeast. We've got city-specific strategies, and then we've got issue area-specific strategies. And so many of these funds that are, sort of double bottom line, sort of high single-digit return, and like good moderate impact sort of spread across a large geographic region, or sort of tangentially related to the impact themes of our program teams, we just don't invest in them because they're not specific enough to clear the impact hurdle that we have with our program teams. So the short answer is we don't do a lot of those kind of managed funds. Next question from Alicia. Really two questions. How do we structure guarantees, and are we developing an agreement to cover, it rolled up on me, an agreement to cover loss? Do you have a tool to actually measure the impact of the investments you made? So again, on the impact, I'll answer that first. It's very program specific. How do we structure guarantees? Most often they're structured as first loss guarantees. They're typically structured as guarantees of payment, of collection, I'm sorry, not of payment. So typically we are providing a guarantee to an intermediary. There's a bunch of underlying transactions underneath it. We'll take a 5, 10, maybe 15% first loss position, but our partner is going to risk share loss with us, and they've got to go through collection proceedings before we write checks in. Those payments that we make are effectively grants into the structure. And as a reminder, everything we do has to be charitable. So there are very specific sort of uses that our guarantee can be limited to that are charitable in nature, according to the Internal Revenue Code. I would point you to our partnership with Locus in the Community Investment Guarantee Pool, where we've partnered with a bunch of different foundations to provide blanket guarantees across a couple different verticals. There's a lot of information at the guarantee pool about how guarantees can be used, philanthropic guarantees can be used, and they're a great resource. Okay, can we share a little bit, this comes from Rebecca, can we share a little about how the team weighs opportunity costs? Again, this is very program specific. Currently, we do not allocate resources up at the beginning of the year, X million to this team, Y million to that team. What we try to do is work very collaboratively with the program teams. Much of the investing that we do is bespoke. So we are co-creating an opportunity with our program teams or with our investees, or they're very specialized investments that take a lot of incubation. So what we're trying to do is sit with our program teams and understand where they are at in their various strategies, what their grants, what the grant making they are doing is accomplishing, and where can we accelerate those investments, to generate more impact. And then we make a transaction by transaction evaluation, trying to keep an eye on what other deals in the same sector or the same opportunity that we might turn down. So it's not a science, it's very much an art. Next question, in what ways can CDFIs help to strengthen the social investing ecosystem? I suspect everybody on the team can answer this. Erica, why don't I ask you where you see CDFIs and social investing sort of working together?
The number one thing that I'm thinking about these days is actually loan policies and lending policies, and ensuring that they actually align with the intended goal and meet the need of what your clients need. Working with CDFIs previously, sometimes the policies didn't necessarily match the intended population. And it was kind of like, well, this is the policy, so we're just going to leave this here, and everybody else needs to kind of meet that. Because we have to work so bespoke, it would be helpful if CDFIs worked a little bit more bespoke, understanding that they definitely have to be going concerns, so we're not saying lose money, but really looking deeply at what are the issues that even led up to the challenges that clients have, customers have. That would be, I think, most helpful for me, because when they have access to other capital, then it makes our jobs easier.
Okay. Thanks, Erica. I'll note that we've done a lot of work work with CDFIs. They've been backbone of the community development finance industry for a long time. You know, we're having a moment, right, for all of us who spent a lot of time in this sector, a lot of money coming into the sector, but it's stratifying rapidly. So the bigs are getting bigger, the smalls are still trying to access capital. We are doing our own reevaluation about what is the need for philanthropic capital in the space, and we're certainly happy to hear from folks. We are running short on time. Team, forgive me, I'm gonna try to rattle through as many as we can. We've got a question around how do we work with other foundations? All the time. We work with other foundations all the time, but it's a pretty small world of folks who have dedicated staff and dedicated resources and doing PRI making sort of at scale, quote unquote. We are quite happy to talk to anybody in the philanthropic space about setting up their own shop or how they can enter the space. You know, it's part of our obligation in this sector to help each other. We firmly believe multiple forms of capital are required to make the change that we want to see in the world. And our grantees, you know, they have to deal with multiple forms of capital all the time to solve problems on behalf of people. So, you know, happy to talk anytime. You've got our contact information. Questions about our endowment. So again, I don't work for the endowment team. Nobody on this team does. We have a close partnership with them. We've largely been the sort of origination arm for many of our MRIs. Our filter on the MRIs is effectively the same for the PRIs. Does it fit program strategy? So, you know, we don't say we're fully aligned if we've got a negative ESG filter on. We don't say we're fully aligned if we generally, you know, invest a lot of money in healthcare writ large, right? It's very narrow and very specific. It's an evolving partnership with the endowment team, but you know, with the endowment, we take no concessionary yield. So there's no below market rate product that we deliver in partnership with that team. It is looking for places where we can scale capital inside a program, strategies that let, you know, our resources don't scale to that level. Moving on, what are the places, organizations located outside your focus cities? Your recommendations talking with local foundations in our area about expanding their impact investing? I do. I mean, there aren't, as I said, a lot of organizations out there that are not national foundations that are doing meaningful program-related investing, but there's a lot of energy in the space. And so when you look at community foundations, donor-advised funds, regional foundations, family offices, I mean, you know, there's not a month that goes by that one of us doesn't get a call or multiple calls from multiple family offices or community foundations. We are really happy to talk to folks about how to do this. We've got a particular opinion on that. And if you're going to do something, you do it well. But there are lots of opportunities to partner with other organizations with capacity. So we're happy to talk to folks about that. What else do I have here? Talk about interaction and integration with your program teams. Are they more often requesting funding tools to solve problems, or is the team constantly reaching to bring tools to them? It depends on the program team. So, you know, this is an evolution, right? Private foundations are mostly have a hammer and a nail problem, right? They have a problem, they're a grant maker, that problem needs a grant, right? And so that is a behavior that exists in most private philanthropy. It's not wrong, but we think that these problems require different solutions that grants alone can't solve for. So it works differently with every program team. Some of our program teams, like the place-based work that Tasha leads, there's basically not a single part of their strategy that does not require PRI making to be successful. Other teams that we work with have portions of their strategies where, you know, PRI making is required to accelerate the impact that they want to make in the world, but in other areas it's less relevant. And then we have a few program teams where, you know, there's no one part of their strategy that requires a program-related investment to accelerate the impact, but there are opportunistic, there are opportunities where we can be opportunistic to accelerate their goals. You know, one of our best examples, I think, is of our education team, where they're very focused on access and success to higher education for low-income, first-generation students of color. A lot of their work is policy making and working with public universities, et cetera. You know, PRI making to a public university, you know, a multi-hundred-million-dollar, multi-billion-dollar public higher ed institution, not super relevant to them. But we found opportunities to invest directly in companies or into certain technologies or into partnerships that have really been massively powerful inside of that strategy. It's not everything they do, but there are some great examples of where we can do it. So I am 1 minute over. I am sorry that I think we answered almost every question. Happy to follow up with anybody who didn't get a question answered if you want to send an email. And Chris, I think I'm going to turn it back to you. Let me just say on behalf of the team, thank you very much for joining us.
Yes, thank you everyone for joining us. I just dropped a link into the chat that hopefully works. It should go to a Google survey with just a few questions about our webinar today. If you have a few minutes to tell us what you thought and if this was useful, so we can decide if we should do it again. We would love to know. So thank you all, and you'll be getting in your email some follow-up from us that includes this recording. So look for that, and enjoy the rest of your day. Thank you.
Thanks, everyone.